How does an exclusive, like 200-person underground music after party in Istanbul somehow transform into a $16 billion financial weapon in just 7 days?
Oh, man.
Right. And not just a hypothetical weapon either. I mean, one that left behind this massive trail of furious retail traders, completely liquidated accounts, and, well, blockchain detectives scrambling to reverse engineer the absolute carnage.
Yeah, it genuinely sounds like the plot of some cyber financial thriller.
Totally.
But it is exactly what we saw unfold in the crypto markets. It's really this story of incredible real-world technological utility just colliding head-on with some of the most ruthless market mechanics ever designed.
Welcome to today's deep dive. We are looking at a really fascinating stack of sources for you today.
Quite a stack.
We've got comprehensive crypto news reports from CoinMarketCap, Pain News, KuCoin, and MEXC, plus some intense blockchain investigator reports, and we even have the official white paper.
Right.
And all of this material is centered on a single project called RaveDAO and its native token, RAVE.
And our mission today is to unpack a very specific duality here. We need to figure out how a project that actually has genuine, real-world utility.
Yeah, real utility.
Right, we're talking about tangible, life-changing philanthropic impact here. How that simultaneously triggered one of the most controversial 6,000% short squeeze market manipulations of April 2026.
Right, because before we get into the financial fireworks and the liquidated accounts, we first need to establish what RaveDAO actually built.
Exactly, you have to understand the foundation first.
Because the real-world utility of this project is exactly what made that financial frenzy so convincing to traders in the first place. Like, the hype didn't just fall out of the sky.
No, not at all.
As I mentioned with that Istanbul after-party, RaveDAO launched in November 2023 at DevConnect. And since then, it has scaled into this massive global Web3 entertainment protocol.
Global is the key word there.
Yeah, they've hosted sold-out events in Dubai, Singapore, Amsterdam, Hong Kong, and New York. I mean, we're talking over 100,000 total attendees, averaging about 3,000 people per event.
And importantly, they generated $3 million in actual event revenue in 2025 alone.
Wow.
Yeah, this isn't just some theoretical digital product waiting for adoption, They use what they call a decentralized chapter model.
Oh, interesting.
So local organizers apply to host events under the global brand, which is why they often describe themselves in the sources as the TEDx for music.
Okay, let's unpack this. So for you listening, it's like combining Ticketmaster's infrastructure, a global franchise model like McDonald's, and a massive charity, all running invisibly on a blockchain.
That's a great way to frame it.
And the tech behind it is actually really impressive. They launched something called RaveScan 2.0.
Right, the ticketing infrastructure.
Exactly. It's an on-chain ticketing infrastructure built on the Base network, which is Coinbase's Layer 2 blockchain. It basically processes tickets as NFTs to kill the scalper secondary market.
Which is huge.
And it works. I mean, they successfully handled $4.2 million in ticket sales in a single 24-hour window.
The choice of the Base network is crucial there, too.
Why is that?
Well, if you try to process thousands of simultaneous ticket purchases on the Ethereum mainnet, the network congestion and gas fees would be disastrous.
Oh, right, the fees.
Yeah, you might pay a $50 transaction fee for a $20 concert ticket.
Nobody's doing that.
Exactly. But Base, as a layer 2, allows them to process these high-throughput drops at fractions of a cent per transaction. It makes the technology totally invisible to the consumer.
Okay, that makes sense.
But what's really fascinating here is the concept of proof of participation. These NFT tickets aren't just digital barcodes to get you past the bouncer. They actually act as evolving digital identity markers.
It's getting stuck on the ticket aspect. If I buy a ticket on Ticketmaster, I go to the show, the barcode gets scanned, and the ticket's utility is over. Are you saying these NFTs stay active?
Yes, exactly.
How does holding a used concert ticket actually give me any real power or identity?
Because traditional ticketing is purely transactional. You buy, you consume, the relationship ends.
Right.
But with RaveDAO, that NFT ticket stays in your digital wallet permanently. It builds an immutable cryptographic record of your engagement.
Oh, wow.
Yeah, it fundamentally shifts fans from being passive consumers into active ecosystem owners. Because you hold that proof of participation, you can use the Rave token for DAO governance.
So you actually get a say in the protocol.
You literally get to vote on future event locations or, which artists they book next. Plus, you get VIP access to future drops. You are building a verifiable cultural reputation on-chain.
So it's almost like keeping your vintage Pink Floyd concert t-shirt, but the shirt actually acts as a backstage pass for life.
Right.
And it grants you a voting seat in the company's boardroom.
That is a perfect way to look at it. And the philanthropic side of this boardroom, so to speak, creates an incredibly powerful narrative.
It's genuinely amazing. They have this initiative called Rave for Light, where they donate 20% of their event proceeds directly to charity.
20% is massive.
It is. In 2025 alone, they funded over 400 cataract surgeries at the Tilganga Eye Center in Nepal.
Just incredible.
They also funded 150 meditation programs at Nalanda West in the U.S. I mean, they are literally restoring people's eyesight using the profits from electronic music events.
Which creates incredible brand loyalty. It's not just about targeting. It's what the sources call entertainment-driven Web3 with a measurable social impact.
Yeah.
It is very hard for the market to be cynical about a protocol that is curing blindness.
Exactly. And because RaveDAO had this squeaky clean, proven, real-world revenue model, they started attracting massive mainstream partnerships.
Which is where things start to accelerate.
Yeah, which, as we'll see in a minute, acted as a total smokescreen for the tokenomics. They secured collaborations with major electronic artists like Don Diablo and Vintage Culture.
Big names.
Right, and they partnered with massive industry giants like Warner Music, 1001 Tracklists, and the Amsterdam Music Festival.
And then came the major institutional catalyst.
The big one.
Coinbase announced it would launch spot trading for the RAVE token on February 11, 2026.
Wow.
A listing on a major U.S.-regulated exchange like Coinbase is widely viewed as the ultimate stamp of legitimacy in the crypto space. It just opens the floodgates to entirely new cohorts of retail and institutional investors.
They even partnered with World Liberty Financial, or WLFI, for the Korea Blockchain Week.
So yeah, the stablecoin initiative.
Exactly, to launch the world's first offline payment scenario driven by the USD1 stablecoin. Now, WLFI is a DeFi protocol backed by the Trump family. And just to pause for a second for anyone listening, we are strictly looking at the business and blockchain mechanics of this partnership today. We are not diving into the politics or endorsing any figures, parties, or viewpoints mentioned in the sources. Our goal is just to convey the project's business partnerships impartially.
Absolutely.
But from a pure market perspective, an alliance like that generates massive mainstream headlines.
It does. And if we connect this to the bigger picture, all of these partnerships, from Warner Music to WLFI to Coinbase, created a very specific narrative in the broader market.
What narrative was that?
The narrative of regulatory safety.
Okay, I can see why a retail trader would trust Warner Music. But why did this look safer to the massive institutional players? Why do Wall Street whales care about a music token?
Because of the timing. You have to remember, in April 2026, the U.S. Senate was preparing to vote on the Digital Asset Market Clarity Act.
Oh, right, the big regulatory vote?
Yeah, the entire crypto market was incredibly anxious about which tokens would be suddenly classified as unregistered securities and just regulated out of existence.
Makes sense.
But RaveDAO is an entertainment protocol.
Yeah.
It generates real, auditable fiat revenue from physical events and ticket sales.
So it looks totally clean.
Exactly.
Huh.
To the whales, this looked like a safe live-to-earn bet. A token tied to concert tickets and eye surgeries felt entirely insulated from the regulatory crosshairs. Big money saw it as a safe haven to park their capital.
All right, so we've established the foundation, a highly successful ticketing platform, millions in real revenue, massive mainstream partnerships, the illusion of complete regulatory safety.
Perfect setup.
But how exactly did that fundamental success warp into an explosive 80x financial anomaly in mid-April 2026? Because the charts in these reports look completely detached from any version of reality.
They really do. I mean, in just 7 days, the price of the RAV token went entirely parabolic.
Just a straight lineup.
It skyrocketed from 25 cents to an intraday peak of nearly $28. That is a 6,000% surge in a single week.
At its peak, the market capitalization hit $3.1 billion.
Staggering.
But the fully diluted valuation, the FDV, reached a staggering $16 billion.
Yeah.
For a brief moment, this music ticketing token surpassed the valuation of established multi-billion-dollar foundational blockchain networks like Avalanche and SUI.
And the reason for that $16 billion valuation lies hidden in the tokenomics, which the market largely ignored due to the hype.
Right.
The maximum supply of the RAVE token is 1 billion tokens. However, the sources note that only about 24.8% of those tokens were actually circulating in the market.
So treating a $16 billion FTV as real value is basically like a neighborhood lemonade stand selling one cup for $10 and suddenly claiming their backyard business is worth $10 million because they, could theoretically squeeze a million lemons someday.
That's a hilarious analogy, but yeah.
Math is a total illusion.
That is exactly the FTV trap. Let's look at the hard math from the sources. The project generated $3 million in annual revenue, but the market was valuing the total theoretical token supply at $16 billion. That means the revenue to FTV ratio was less than 0.01%.
That is wild.
From any fundamental investing standpoint, that is completely absurd. But it gets so much worse when you look at the on-chain data to see who actually held that 24.8% circulating supply.
Oh man, the data on this is terrifying. 99.95% of the total token supply was held in just the top 10 wallets.
Let that sink in.
And roughly 90% of the entire supply was locked in just 3 Gnosis-safe multisig wallets.
Yes, they use Gnosis-safe multisigs, which is essentially a highly advanced digital bank vault.
Right.
It requires multiple executives to digitally turn their keys at the exact same time before any funds can move out of the wallet. It's intended to be a security feature to prevent hacks.
Sure, that makes sense.
But here, it meant absolute centralized control by the project team.
Hold on. If 90% of the token is controlled by the team in this giant digital vault, how on earth did institutional giants like Coinbase or Warner Music not see that as a massive, glaring red flag before partnering with them?
Because the institutional partners are usually evaluating the business utility, the user acquisition, the tech infrastructure.
Not the tokenomics.
Right. They see a ticketing system on Base that works flawlessly. They don't always do a forensic audit of the granular on-chain token distribution.
That is such a blind spot.
It really is.
Yeah.
And when 90% of a token is locked up by a single entity, the public market is starved of supply. It creates extreme token scarcity.
And that's what caused the spike.
Exactly. In that environment, even a tiny amount of retail buying pressure will cause massive violent price spikes because there is virtually no sell-side resistance. Nobody else has tokens to sell.
Which brings us to the actual heist.
Yes.
Because this highly centralized supply structure wasn't just a red flag for investors, it was the exact weapon used to execute what analysts in our sources called a textbook short-selling kill. Let's walk through exactly how they pulled this off, because the psychology here is wild.
It's devious.
10 hours before this massive price explosion happened, wallets associated with the RaveDAO deployers transferred roughly 18.58 million tokens, and some sources note it was up to 30.58 million tokens, worth around $42 million at the time, straight to the BitGet exchange.
Yeah, you have to understand the psychology of blockchain transparency here.
Okay, break that down for us.
In the crypto markets, every move is public. When a massive transfer moves from a team vault to a centralized exchange, retail traders and automated trading bots see it instantly.
Because it's all on the ledger.
Right. And it signals one thing to them, an impending dump. It tells the market, hey, the insiders are moving their massive stack of tokens to the exchange so they can sell them.
So the retail traders think they have an inside scoop.
Exactly.
They see the transfer and think, I'm going to front run the team's sell-off. They take the bait hook, line, and sinker.
And they short it?
Yeah, they heavily short the token, actively betting the price is about to crash. The data showed that on Binance, a staggering 74% of all trading accounts tracking this token held short positions. Everyone was betting against it.
But the insiders knew the retail bots were watching the blockchain.
Oh, wow.
They intentionally performed this massive transfer in broad daylight to bait the algorithms. It was a complete trap.
Because they never intended to sell.
Because once the short interest peaked and the trap was fully set, the team didn't sell. They simply withdrew those tens of millions of tokens right back off the exchange.
Here's where it gets really interesting.
Yeah.
It's like leaving a bank vault door wide open to bait a bunch of robbers inside, and the second they step in, you slam the door shut, lock them in, and then you start charging them an hourly rent just to exist inside the vault.
That is the exact mechanic of a short squeeze.
That's brutal.
Because the team withdrew the tokens, the liquidity on the exchange instantly vanished to zero.
It just evaporated.
Exactly. And as the price started to naturally tick up slightly, those short sellers began to get liquidated.
Because they were trapped.
Right. When you are short and you get liquidated, the exchange forces you to buy back the token at the current market price to cover your debt.
Which pushes the price up even higher.
Exactly. It creates a violent liquidation cascade.
Wow.
Forced buying pushes the price up, which triggers the next level of short liquidations, which forces more buying, which pushes the price up again in a massive green candle.
Unbelievable.
In a single day, between $37 million and $47 million in short positions were completely wiped out.
Okay, but what about the hourly rent part of my analogy? That's what the sources call the funding rates, right? Why were these traders bleeding out while they were trapped?
Yes, the funding rates are the hidden killer here.
How so?
Well, in perpetual futures markets, you don't have an expiration date on your contract like traditional finance. So to keep the contract price tied to the actual token price, the exchange uses a funding rate. If everyone is shorting, the shorts have to pay the longs a fee to keep their positions open. Because 74% of the market was trying to short the token, the annualized funding rates hit an absurd negative 1,000% to negative 4,000%.
Wait, really? Negative 4,000%?
Yes. That means the short sellers were bleeding massive amounts of capital, paying exorbitant fees to the long holders every 8 hours just to stay alive.
That sounds like torture.
It was a slow, agonizing drain on their capital, forcing them to eventually capitulate and buy back in.
And because the insiders controlled 90% of the tokens, doing this cost them practically nothing.
Precisely. It was a near-zero cost maneuver for the controlling entity. They simply moved tokens to an exchange to manipulate market psychology, withdrew them to create a sudden liquidity vacuum, and then casually watched the automated mechanics of the derivatives market extract tens of millions of dollars from traders.
Traders who unwittingly became exit liquidity. But, I mean, you cannot engineer a multi-million-dollar liquidation cascade in broad daylight on a public ledger without drawing the attention of the industry's top watchdogs.
No, you definitely can't.
The fallout from this was intense. On-chain investigator ZachXBT publicly accused RaveDAO of insider manipulation.
He didn't hold back.
No, he was so confident in his analysis that he eventually offered a $25,000 bounty from his own funds for whistleblowers to come forward. He even messaged the RaveDAO co-founder directly before going public and famously tweeted that he was left on red.
The pressure mounted incredibly fast. Exchanges couldn't ignore it either.
Right, because their users were the ones getting wrecked.
Yeah. BitGet CEO Gracie Chen initiated an internal investigation into the trading activity. When you have on-chain detectives pointing to specific multi-sig wallets and timestamp transfers that perfectly align with market manipulation, the plausible deniability shrinks rapidly.
And how did RaveDAO respond to all of this heat? With a muted little tweet.
Unbelievable.
They just advised users to remain mindful of market volatility and the risks of leverage. That was literally it.
Just brushing it off.
Meanwhile, community analysts started digging much deeper and noted that for a project handling millions in ticketing revenue and partnering with Warner Music, the protocol has 0 public code repositories or third-party security audits.
Which is a glaring vulnerability that the hype totally masked.
How did people miss that?
Without public code or independent audits, users and traders are relying entirely on blind trust. And when that trust was fractured by the manipulation, the market sentiment shifted violently.
Yeah, the crash was inevitable. The token dropped 40%, falling back below $13. The sources point out that the technical charts formed a bearish double top, and the open interest failed to break its previous highs. But what does that actually mean on the ground for a trader looking at this?
Well, a bearish double top means the price tried to hit its peak twice, failed both times, and investors lost hope, creating a definitive downward trend. And open interest is simply the total number of active leverage contracts in the market. When that open interest stops growing, it means the fuel for the rocket is gone.
The hype died.
Exactly. The adrenaline wore off, the new money stopped flowing in, and the reality of the highly centralized structure finally set in.
So it's over for the token price.
Pretty much.
Yeah.
But this entire saga is really a masterclass in crypto survival for anyone listening to this.
Definitely.
It highlights 3 critical rules. First, never just look at the market capitalization of an asset. You must always verify the circulating supply.
Right, the lemonade stand math.
Exactly. A high market cap driven by a tiny circulating supply is a massive red flag. Second, check the revenue to valuation match. If a project makes $3 million but is valued at $16 billion, the math does not support the price, no matter who they partner with.
Good point.
And third, realize that in transparent on-chain markets, large exchange deposits are not always a guaranteed sell-off. Sometimes, as we saw here, they are weaponized psychological bait, designed specifically to trap you.
It's just wild to look at the sheer duality of RaveDAO.
It really is two different worlds.
On one hand, you have a project that successfully executed real-world high-tech event ticketing on the base network to defeat scalpers. They built a system that genuinely works, and they use the profits to literally fund surgeries to restore people's eyesight in Nepal. That is incredible positive innovation.
But they wrapped all of that genuine utility in a tokenomic structure that was highly centralized, completely opaque without audits, and ultimately weaponized to execute a ruthless, leverage-fueled market manipulation against their own traders.
It's such a contradiction.
It is a stark reminder that the underlying technology is neutral, but the economic design is where the true intent of a project is actually revealed.
So what does this all mean? It really leaves you with something to chew on. If a project uses blockchain technology to eliminate predatory ticket scalpers, but then uses that exact same blockchain to engineer a predatory financial squeeze against its own traders. Wait, let me rephrase that. Does the technology actually solve human greed, or does it just give it a much more efficient operating system?